Hello everyone. Good morning. My name is Soberss Nebhnani. I am the client relationship manager with Jitendra Chartered Accountants. First of all, I warmly welcome you all to today's session. On behalf of our company, I would like to thank you for taking time to join us today for the webinar about understanding the UAE corporate tax with the key takeaways. Before we start our webinar, I would like to give you a little brief introduction about our company. Jitendra Chartered Accountants, a division of Jitendra Consulting Group, is operating in UAE from last 21 years. Jitendra Chartered Accountants is a leading auditing, accounting, and consulting firm, providing various kinds of business services under one roof, having a team of professionals from diverse multilingual and multicultural backgrounds who serve our clients locally and globally. We are listed and approved by Ministry of Economy, banks, free zone, and mall management for sales certificate. We at Jitendra Chartered Accountants provided services like audit, accounting, AML compliance, economic substance regulation, VAT, and corporate tax services. We are registered tax agent with FTA. Further, we provide other services like business setup in free zones, mainland, UAE, and foreign offshore, along with PRO and liquidation services. In addition to that, we also provide services for trademark registration, copyright, and patent filing in the UAE and around the world globally. So without further ado, let me introduce you to our keynote speaker for today's event, the company partner, Ms. Divya Gianchandani. Ms. Divya Gianchandani has vast experience in auditing, accounts, and finance. And as a member of Institute of Chartered Accountants of India, she has been exposed to UAE corporate world since 1997. I would request Ms. Divya Gianchandani to please give us her overview of UAE corporate tax. Ms. Divya, over to you.
Thank you, Soberss, for the introduction. Hello, friends. Good morning and a warm welcome to all of you. And thank you for joining us today on Understanding UAE Corporate Tax Laws with Key Takeaways. As we are all aware about the complex nature of taxation, our team has worked hard to make a simple presentation on corporate tax laws applicable and effective from 1st of June 2023. Though executive law is still awaited, and obviously some of the questions will remain unanswered until full law is issued, it is our continuous endeavor to serve and support our clients. Therefore, I hope you will find this session informative. Thank you for joining us and giving us this opportunity to serve you. Without taking much of the time, I will hand over to Mr. Soberss, who will be introducing the key speakers of today. Over to you, Soberss.
Thank you, Ms. Divya, for your overview on corporate tax. Now, I want to introduce you to our speakers of the webinar, Mr. Rajiv Thakkar, Senior Tax Consultant, Mr. Chetan Mandani, Tax Consultant, Mr. Sajjad, Tax Consultant. I request you to put your questions in Q&A box and please address to the panelists, and the same will be taken after panelists will finish with the presentation. I will request Mr. Rajiv to start with the understanding the UAE corporate tax with key takeaway. Mr. Rajiv, over to you.
Thank you, Mr. Soberss. Thank you for the brief introduction, and thank you, Mrs. Divya, for the very keynote. Very good morning to all. As we have committed last time, that whenever the UAE issues the corporate tax law, we will come up with the webinar. So yes, today we are fulfilling our commitment And with this, we also commit that whenever there is an executive regulations will be issuing, we will also come up with our new webinar on the corporate tax full understanding with the executive regulations, which may be a webinar or the physical seminar. So to start today with our session, the topics which we are going to cover is like what is corporate tax, effective date, taxable persons, permanent establishment, exempt persons, uh, applicability of corporate tax on the free zones, reliefs, deductible expenditure, non-deductible transaction with the related parties, connected persons, tax laws, and general rules. So first, we'll start with what is corporate tax. I do understand that our many of the attendees might know what is corporate tax, as they might be coming from the particular legislation where the corporate tax is already there. But we also understand that many of the attendees, for them, the corporate tax is a new word or is a new taxation system. So please bear with me for starting 2 or 5 minutes. So let me explain what is corporate tax. Now, the corporate tax is imposed by the decree law on the judicial persons and business income. Simple, that legal company doing a business, having an income, tax is imposed on them. Corporate tax is a tax on the profit of corporation. So it is not something like VAT, where on every sales invoice, the companies are charging VAT. In the corporate tax, on your net profits are subject to corporate tax. Now, to calculate a corporate tax, there is a simple formula which I have brought down at here. Like taxes are paid on the taxable income, and taxable income we arrive by sales minus cost of goods sold minus general administrative expenses and selling and marketing expenses minus depreciation, other operating cost, and plus minus with regards to the corporate tax, various provisions. So with this, we will come to our taxable income. Now, before we start, let's understand what is the tax history. The first known taxation was in the ancient, and then in the Chinese civilization also, we see that the word tax came from the Latin word to assess. To assess, this tells us our first guidelines that the corporate tax, we have to do the self-assessment. We have to see that what is our taxable income, and based on that, we are required to file the corporate tax. Now we might have one question that why the government is collecting the taxes. So it's a simple that the government will invest whatever taxes they are collecting from the public in general for their sovereignty works like infrastructure, military, research and development, scientific, culture, and other public works. Now, we all know that the UAE has come up with the 9% corporate tax. At presently, this 9% corporate tax is the lowest in the world, or I should say, a minimum in the world. As far as the GCC is concerned, UAE is the lowest, and on the other table, if I can see, there are many legislations or many countries or multinational countries which are where the charging of corporate tax is way higher. Some are like at 20%, 25%, some are at 34 or 30% also. Moving next, at here, we have tried to compare that what is the direct tax and what is the indirect tax. Indirect tax at presently, we all know, value-added tax, excise duty, and customs. Now, under the direct tax comes the corporate tax. Now, the corporate tax is payable by the person himself or the company himself on its net income. But in the indirect tax, the taxes are paid by the customer, and ultimately it is paid by the end consumers. And the taxes are charged based on the goods provided or services rendered. In the corporate tax, the rate of the tax is based on the profit, and in the indirect tax, the rate of the indirect tax is in general, or it is specific to the commodity. Like in value added tax, we know that the general rate is 5%, but for the exports, it is 0%. In excise duty, there are 50% and 100% depending on the product. Now, let us start the corporate tax in UAE. We all know that in the start, the Ministry of Finance has issued the public consultation document in 28 April 2022. This was a very welcome note from the government that they asked us that what other changes or what kind of changes the public requires in the corporate tax, because ultimately here the government does ultimately at here the government imposes the corporate tax, but keeping in mind that it should not be a hassle to the general public. Then on 3rd October, they issued the Federal Decree Law number 47 of 2022, which gave us the very good insights on the corporate tax. At here, the important date for all of us is 10th October 2022, when this Federal Decree Law was officially published in the Gazette. Now, why it is important? Because we all know that the corporate tax is coming into effect from 1st June 2023. But there is one rule in the corporate tax, that is General Anti-Abuse Rules. We call it GAR. Under this, if any company or any taxable person do any kind of transitional changes or the legal changes to have a corporate tax benefit, like paying less taxes or claiming high losses, will not be considered in the eyes of the law, in the eyes of the Federal Tax Authority. If the authority comes to know, they will nullify that particular transaction or particular legal structure. So yes, the tax evasion after this Federal Decree Law of 47, many companies or many taxable persons could have done, but the government has stopped them. The government has shown them this red signal that after 10 October 2022, if you do anything, that is the violation of the law. Moving next. What are the corporate tax rates in the UAE? It is 0% and 9%. For the individual and judicial person, at here judicial persons means company. Company means any kind of companies, whether it is a LLC, civil company. So for them, the tax rate is 0% up to their net profit of 375,000, or I'll say up to that taxable income of 375,000. Above that, it will be 9%. There are different rules for the qualifying free zone persons. If a free zone company is earning particularly a qualifying income, they enjoy 0% corporate tax rate, which on this, the definition of qualifying income is at presently not defined in the decree law. So yes, we have to wait for the executive regulations or the cabinet decision to have a better understanding on what is included in the qualifying income and what is not included in the qualifying income. And if any free zone is not earning any qualifying income, so yes, they will be paying 9% corporate tax above their taxable income of 375,000. Now we understand that in our attendees that there are many multinational organizations are there or multinational entities are there. So they will be under dilemma that under base erosion and profit shifting system, BAPS, will they be come under 15% or 9%? At presently, the corporate tax law is silent on that, but we expect that executive regulations will define more on this. Moving next, the effective date and its implications. As the corporate tax is coming from 1st June 2023, so it is not like that from that it's day itself the each and every company in UAE is subject to corporate tax. The wording in the law is such that the effective date of the corporate tax is from 1st June 2023, on which date the financial year are starting or after. So in this case, if let us understand with an example, if your financial year ends on 30th June, so yes, for you, the corporate tax is applicable from 1st July 2023. So your first tax period will be 1st July 2023 to 30th June 2024. And the corporate tax return needs to be filed within 9 months from the end of the corporate tax period. So for you, the first return filing deadline will be 31st March 2025. By that date, you are required to, by law, or you are suggested to file the corporate tax return with the payments. Now, in the UAE, most of the companies, or I should say almost 90% of the companies, are following the financial year end of 31st December. So for them, in 2023, there is no corporate tax. Their first corporate tax period will be from 1st January 2024 to 31st December 2024. And the first, and then deadline for them is 30th September 2025. Another example, that if a company's year end is 31st March, so yes, for them, the corporate tax applicability is little bit more delayed. So for them, the corporate tax, first corporate tax period will be 1st April 2024 to 31st March 2025. And their first filing deadline will be 31st December 2025. Now, when we talk about that, when our corporate tax period starts, so let's say for the 31st December, the first corporate tax period starts on 1st January 2024. So at that date, we should have our opening balance sheet or opening assets and liabilities, which should be in line with the transfer pricing rules. Now, what are the transfer pricing rules and how it can affect your opening balances will be discussed later by my colleague, Mr. Sajjad. Now, first we understand that what are the corporate taxes. It's 0% and 9%. Now we'll understand that on whom the corporate tax is applicable. First, a legal person incorporated in the UAE, including a free zone person. Yes, any company which is incorporated in the UAE, whether it is LLC, civil company, sole establishment, free zone entity, or free zone company, or limited, on all of them, the corporate tax is applicable on their worldwide income. It is not only their UAE income, it is on their worldwide income. Now we have another is a foreign legal person effectively managed and controlled in the UAE. Now effectively managed and controlled in the UAE, for them, the corporate tax applicability will be on their worldwide income. A natural person who conducts a business or business activity in the UAE, that means a sole establishment or a civil company, including partners in an unincorporated partnership and family foundation. Yes, on them also the corporate tax is applicable. At here, it is important to note that the corporate tax is not applicable on the natural person. Let's suppose that I am getting a salary from the company. On my salary income, there is no corporate tax. But if being a natural person, I'm running a business, let's say sole establishment, or I'm doing any activity, let's say without any license, so still I'm covered under the corporate tax. So coming back to our example, a natural person who conducts a business or business activity, on them, the worldwide income will be covered under the corporate tax as if it relates to the business activity conducted in UAE only. On this also, we expect that the cabinet decision will throw some more light that how this will be affected. Moving next, non-resident person. Previously, we discussed on the resident person. Now, non-resident person who is having a permanent establishment in UAE, the taxable income attributable to their PE in UAE will be covered under the corporate tax. Now, What is the PE? We'll be discussing in the next slide itself. The another is they derive state source income. So if the company is earning if a company is a non-resident person earning a UAE sourced income, which is not attributable to the PE, yes, their income are subject to corporate tax. And the last, not the least, who are having a nexus in the UAE. So that taxable income attributable to the UAE will come under the corporate tax purview. Moving next, as just in the previous slide, we discussed that a non-resident permanent establishment are covered under the corporate tax. Now, who are these non-residents permanent establishments? So for that purpose, they have defined that what is covered under the PE and what is not covered under the PE. So first, let us discuss what are the inclusions. If that permanent establishments, place of management, where the normal commercial decisions are taken, is in UAE. They are having an office, factory, branch, land, building, or they are into the installation for the exploration of a renewable or non-renewable natural resources, a building site, construction project, which are there for more than 6 months are covered as a permanent establishment. So if your company is a non-resident and are covered in this inclusions, then yes, you are covered under the corporate tax. The exclusions. The exclusions in the permanent establishment are that if you are not directly in the UAE, let's say you are storing or displaying goods of merchandise belonging to other person. So yes, that other person is not the PE under non-resident. If you are keeping a stock of goods or merchandise belonging to the person for the sole purpose of processing by another person, so yes, you are not a PE. If you are purchasing goods or merchandise for the non-resident person, not covered. You are not covered under PE. Conducting any activity of a preparatory or auxiliary nature for the non-resident person, you are not under PE. Moving next, in the non-resident itself, we see that state source income are covered under the non-resident and they are liable to the corporate tax. Now, what are this state source income? Those are like you derive a state source income from a resident person, derived from a non-resident person, and the income received has been paid or accrued in connection with attributable to a P of that person in the state, or accrued in or derived from activities performed, assets located, capital invested, rights used, or service performed or benefited from in the state. Now, at here, the state source income is basically more on that from whom you are getting the income. If those are resident person or those are non-resident person, or you are getting the assets income based on your asset located or the capital invested, then yes, you are being a non-resident also, you are running a state source income and you are subject to corporate tax. Moving to our next topic, exempt persons. Simple and very straightforward. Now, exempt persons includes government entity because they are doing the services. There are other also government control entity in an extractive business, because a person who is engaged in the extractive business are already subject to emirates level taxation. A person engaged in a non-extractive natural resource business, qualifying public benefit entity, qualifying investment fund, public pension or social security fund, or a judicial person incorporated in the state who is wholly and controlled, who is wholly owned and controlled by an exempt person. So these are the exempt persons on whom the corporate my colleague Mr. Chetan to take over from this. Thank you.
Thank you, Mr. Rajiv. Thank you, Mr. Rajiv. So moving forward, let's discuss the tax groups. Tax group is very common in UAE among the big groups, as currently we have tax groups in VAT. Companies can form a tax group if they meet certain conditions, and they can submit the single VAT return for the group. Similarly, under the UAE Corporate Tax also, tax group can be formed to reduce the compliance burden if certain conditions are met as prescribed in the law. So let's understand the conditions to form a tax group through an example. So here we have two companies, ABC and XYZ. So here ABC is a parent company and XYZ is a subsidiary company. Just 1 minute. Okay, sorry for technical glitch. So here we have two companies, ABC and XYZ. So here ABC is the parent company and XYZ is a subsidiary company. So there are certain conditions. So let's understand which are these conditions. So the first one is both the companies should be, both the persons should be juridical person. That means legal persons. So natural person cannot be a part of the tax group. So we will check whether the ABC and XYZ both are juridical persons. If yes, we need to check the another condition. And if no, they cannot form a tax group. So the next condition is that both the persons should be resident persons. So only if both the companies are resident, then only the tax group can be formed. Non-resident person cannot be a part of the tax group. Non-resident and resident persons, Mr. Rajiv explained in the earlier slide. Now the resident person means legal persons incorporated in UAE, foreign companies effectively managed and controlled from the UAE, and natural persons. But as we understood in the first condition, that the natural person cannot be a part of the tax group. So if both the companies are resident person, we will check the next condition whether the third condition is that neither the parent company nor the subsidiary should be exempt or qualifying free zone person. So the qualifying free zone person we will understand in the next slide. So if yes, both the companies are non-exempt or non-qualifying free zone, we need to check the another condition that whether both the companies are following the same financial year and accounting standards. If yes, then whether ABC being the parent company of the XYZ holds at least 95% of the share capital, voting rights, or profit and loss of the XYZ, either directly or indirectly through any other subsidiary. If yes, they can form a tax group. If no, they cannot form a tax group. But here, even if they cannot form a tax group, there is one more condition that if both the companies have a mutual holding of 75%, common holding of 75% or more, then there is a provision that they can set off the losses. That condition, that provision will be explained by my my colleague, Mr. Sajjad, in the next slides. So moving to the next slide, let's understand the advantages and disadvantages of forming a tax group. So first we will understand what are the advantages of forming a tax group. So the first advantage is that there will be a no applicability of arm's length principle and transfer pricing documentation. It is that because that the tax group is required to prepare consolidated financial statements. That means that all their group transactions will be nullified, and it will not have any impact on the profit and loss account of the company. Second provision is that losses of one company can be set off in the same year with the other company. And third one is that there will be a lower compliance burden as there will be a single corporate tax return as well as single corporate tax payment. Now let's have a look at the disadvantages of forming a tax group. So the biggest disadvantage is that the tax group will be considered as a single taxable person, and hence they will have a single exemption limit irrespective of the tax group members. So let's say you have 4 companies in a tax group. Even though you have 4 companies, you will eligible for only the single exemption limit, that is 83,75,000. And the next one is that for a tax group, it is mandatory to prepare the consolidated financial statement. Now moving to the next slide, we have an example here for the separate registration and group registration. Just go through this example once, then we will understand this example. So here we have 3 companies, company A, company B, and company C. So let's assume that all the 3 companies met all the conditions to form a tax group. So they are eligible to form a tax group. Now, first we will consider all 3 as a separate entities. So all the 3 companies will have their individual separate basic exemption limit. Now, in this example, company A is having a taxable income of 300,000. Company B is having a taxable income of 500,000, and company C is having a loss of 200,000. So after deducting the basic exemption limit, company A will have 0 taxable profit for corporate tax. Company B will have a 125,000 profit after deducting 375,000 exemption limit, and company C will not have any taxable profit as they are having the loss. So in this example, company A is not paying any tax. Company B is paying 11,250, that is 9% on 125,000, and company C will carry forward their losses to next year. Now, let's assume that they are forming a tax group. So moving to the last column, that their total taxable income will be 600,000, and they will have only the single basic exemption limit, that is 375,000 only. So their total taxable profit for the group will be 225,000, and on that they will pay a corporate tax at the rate 9%, that is 20,250. So here we can clearly see that because they form the tax group, that's why they are paying 9,000 higher tax in this example. And this is the one of the biggest disadvantage of forming a tax group, but this condition may vary depending on the profitability of the companies. Now let's move to the next topic. So we have a next topic of transfer of properties within a qualifying group. So here let's be very clear first that the tax group and qualifying group both are different. So similar to the tax group, for qualifying group also there are certain conditions which they need to fulfill. So what are these conditions? The first one, all the companies, all the persons should be juridical persons, either resident or non-resident, doesn't matter. In tax group, only the resident person can be a part of tax group. Here resident and non-resident both can be a part of qualifying group. Second condition is that either directly or indirectly owning a 75% or more of the capital. Third condition is that none of them should be exempt or qualifying free zone person. Fourth condition is that they follow the same financial year and accounting standards. Okay, so if they are this creating the qualifying group, then no gain or losses arising from the transfer of assets or liability within the same qualifying group will be considered for corporate tax purpose. So there will be no impact on the taxes of the company. There are conditions that the asset or liability should be transferred at the book value of the company, and the consideration paid or received shall be equal to the book value, and there should not be any subsequent transfer within the next 2 years outside the qualifying group. So you can transfer within the qualifying group, but not outside the group for next 2 years. Moving to our next slide. So now we have a qualifying free zone persons. So this is one of the key highlight of the UAE corporate tax, as we all know. When the public consultation document was issued, they had given a broader view on this topic. But now in this decree law, they has not specified in-depth provision on this qualifying free zone person. But we are awaiting that they will clarify more provisions in the cabinet decision. So as of now, we need to forget all this public consultation document, as we all know that decree law is already out. So we have a two tax rate for the qualifying free zone persons. First one is 0% for the qualifying income and 9% for the other than qualifying income. And what is qualifying income is again not defined yet and will be specified in the cabinet decision. So let's wait for the cabinet decision. So what are the provisions under which a free zone person will be considered as a qualifying free zone person? Let's understand that. The first one is that they should maintain adequate sustenance in the state. What is adequate sustenance? Again, not defined in law, but if we take the reference from the ESR law, then the company should have physical office, physical premise, and employees in the UAE. And again, that is subjective, company to company, it may differ. The second provision is that they are having the qualifying income. Qualifying income, as I informed, that it is not clear yet. Third one is they have not elected to pay 9% corporate tax. That means qualifying free zone has an option to choose whether they want to pay 0% or 9%. Fourth one is they complying with all the arm's length principle and transfer pricing documentation and any other condition which may be prescribed by the cabinet decision. If they are meeting all the conditions, their qualifying income will be taxed at a 0%, and other than qualifying income, it will be taxed at a 9%. And if these conditions are not met, then the free zone person will have a 9% tax rate. And cabinet may describe any additional provision for the qualifying free zone person. Now moving to our next slide. Our next topic is exempt income. So there are certain income which will not be considered for the calculating the taxable income for corporate tax purpose, and accordingly the expenditure incurred to earn that exempt income will also not be considered, will be disallowed. So what are these exempt income? The first one is dividend and other profit distribution received from a UAE company. So if you are receiving any dividend or any other profit distribution, that will not be taxable, that will be exempt. Second one is dividend and other profit distribution received from a foreign company, participating interest in a foreign company. And third one is any other income from a participating interest. So what is participating interest? That means 5% or greater ownership interest in the share capital or of a juridical person. Fourth one is income of a foreign permanent establishment that meets the condition. Fifth one is income derived by a non-resident person from operating aircraft or ships in the international transportation. So UAE being connected to sea, many companies are operating in this field and they will have benefit of this exemption. Now moving to next slide. Our next topic is relief on the transfer or restructuring of businesses. So if you are selling either your full business or part of your business to another company, then if you meet the certain condition, then your gain or losses arising out of this transfer or restructuring of your business will not be considered in calculating the taxable income. So what are these conditions? The first one is meets all the conditions imposed by the applicable legislation of the state. Second one is either it is a resident person or non-resident person with the PE in the UAE. Third one is that none of the persons should be exempt or qualifying free zone person. Fourth one is that they are having the same financial year and accounting standards. And fifth one is that transfer is undertaken for a valid commercial reason. So now moving to our next slide. We have a deductible and non-deductible expenditure. So what is deductible expenditure? So deductible expenditure means which can be deducted while calculating the taxable income of the company, and non-deductible expenditure which cannot be deducted while calculating the taxable income. Hence, you will have to pay higher corporate tax. So the first one, all the business expenditure will be deductible except capital expenditure. There are certain transactions for which the deduction will not be allowed. So what are these transactions? The first one is that it is not incurred for the company's business purpose. So if you are having any expense which is not for the company business purpose, it will not be allowed to deduct. Second one is that expenditure incurred for earning the exempt income. As we understand in previous slide, that exempt income is also not taxable, hence their expenses to earn that income is also not deductible. Third one is losses arising out of the taxable person's business that is not connected with the business purpose. Fourth one, if any expenditure is incurred for more than one purpose, then there will be a proportionate allowance and disallowance. That means if you have a common expenses, like for example, if you have a taxable income and exempt income both, then you have a proportionate deduction available. Let's say you are paying audit fees of 10,000. That is for both the income. So you have a 80-70,000 of taxable income and 30,000 of exempt income. Then proportionately 70%, that is 7,000 will be deductible and 3,000 will not be allowed to deduct. Now, moving to next slide. So here we have a one specific deduction, that is interest expenditure. So interest expenditure shall be deductible in the tax period in which it is incurred, subject to certain provisions. That only up to 30% of EBITDA, that is earnings before deduction of interest, tax, depreciation and amortization, will be available for deduction, and the balance will be carried forward to the next year and can be deducted in the next year, subject to the same condition of 30% of EBITDA. Another condition is that cabinet may describe a maximum cap amount of interest which can be deducted, and if your total interest expenditure is below that maximum cap, you can the full amount will be allowed, and that 30% provision will not be applicable. Moving to next slide. Here, if you are obtaining any loan from your related party that is not for the business purpose, there are some transactions for which you have which you have obtained the loan, then that interest expenditure will not be allowed to deduct. So if you are obtaining the loan for dividend or profit distribution to a related party, or redemption, repurchase, reduction, or return of the share capital to related party, or capital contribution to a related party, or acquisition of ownership interest, which means these are not the business purpose, not for the operation, then the interest on this loan will not be allowed to deduct. Which means that if the loan is obtained from related party for the business purpose, then the interest can be deducted, subject to all the conditions we understand in the previous slide. And there are two exceptions, that if the loan is obtained, if you can prove that this main purpose of obtaining the loan is not to gain any corporate tax advantage, or if the lender company is paying the corporate tax either in UAE or in any other country equivalent to 9% or more on this interest income, then the interest paid will be deductible. Moving to next slide. we have a entertainment expenditure, deduction for the entertainment expenditure. So what is entertainment expenditure? So any expenditure that is incurred for entertainment, amusement, or recreation of shareholder or customer or supplier or any other stakeholder of the business, like lunch or refreshment or transportation or hotel expenses, then only the 50% expenditure will be allowed to deduct. So if you have a 50,000 of lunch or refreshment expenses for your employees and customers, then only 25,000 will be allowed to deduct and the balance amount will not be allowed. Now, moving to our next slide, we have a non-deductible expenditure. As I mentioned earlier, that non-deductible expenditures are, that means that expenditure is not allowed to deduct while calculating the taxable income, and it will increase your corporate tax. So the first one is any donations or grants that is paid that will not be allowed to deduct. The fines or penalties paid to the administrative authorities that are also not allowed to deduct. Bribes or any recoverable input VAT that is also not allowed to deduct. And the last one is tax on income imposed on the taxable person outside the state. But in some cases, it can be a tax relief also. So now I will hand over the session to my colleague, Mr. Sajjad, to take you forward with.
Thank you so much, Chetan, for giving me the lead. Good morning, ladies and gentlemen. Moving forward, I would like to discuss term related party. Related party definition in IS 24 is somewhat similar to the explained given by the corporate tax law. Related party relationship is formed when two or more natural persons connected through fourth degree of kinship or affiliation, like a person who is running the business, the father of his son, the uncle of his niece and nephew, the grandfather of his son, daughter. Since all these persons are related parties, relationships are related parties, so any transaction happening between them, it would be a transactions with related party. Similarly, if a person holds 50% or more than 50% share in a company, or a person who by the virtue of power of attorney holds shareholding, these both persons would be recognized as related party to the entity. Similarly, a person with a relationship with its permanent establishment would also be considered as related party. Two partners in a cooperated partnership would also be considered as related parties. Similarly, a person who is a trustee or a founder in a charitable foundation, all these individuals would consider as related parties to each another. On the same side, if a parent company holds more than 50% shareholding in a subsidiary, so by the virtue of its voting right or ability to appoint majority of board of directors or influence the profit, they would get, the parent company would get the controlling of the subsidiary, and this relationship between the parent and subsidiary would be a related party. Moving forward, as per the corporate law, the transaction and arrangement between related party must meet arm's length criteria. So now it is important that we first understand what is arm's length standard. A transaction should be made in such a way that a transaction is executed by two knowledgeable parties without knowing each other as a related party, without giving anybody a favorism, so that the transaction happened between them is at market terms and conditions. Corporate law authorities has dictated that arm's length transactions must be made by the criterion defined by transfer pricing rules. There are 5 methods which has been dictated. First method is the controllable comparable uncontrolled price method. Second method is the resale price method. Third one is the cost plus method. Fourth one is the transactional net margin method. And fifth one is transactional profit split methods. So because of the shortage of time and this topic is very extensive, so I would move to a next. Authorities has dictated that a taxable person required to file details of transactions which is happening between the related parties. And all these information is filed within two files. One file is master file and other file is local file. The master file would contain standardized information for all, whereas the local file, it would include the information of identification of most appropriate transfer pricing method, the reason for selection and the method, the summary of exemptions in the selection of method, the description of material control transactions, and the context of such transactions. Moving to next slide. Now, we need to understand what is connected person. So connected person is a person who directly involves with the operations and the activity of the organization. Tax authorities has made it clear that all the benefits and the payments provided to connected person should be based on the market value defined by arm's length principle or solely for the purpose of taxable person. For example, a company has a hire director. So this director is rendering some services for the company. So the package which they are offering in terms of remuneration or other benefit, it should be comparable with the market rates within UAE jurisdiction. So if any claims which are over and above the market rate, these would not be taken as an allowable expense in the calculation of the taxable profit. Moving to next slide. It is not a cliche that every entity will generate taxable profit on which tax liability would be paid to the authorities in each year. If an entity has generated tax losses, it can be offset with the subsequent period taxable income. However, it should not exceed 70% of the taxable income in the subsequent year. A taxable person can't claim tax relief if following conditions are being there. For example, an entity has income or taxable loss in 23, and its first return period is 2024. So this loss cannot be claimed against a taxable income of next year. Similarly, if a company is operating in a free zone and generating qualifying income, the company is creating a taxable loss, by somehow the activity has been changed. So now the exempted activity is being converted to taxable activity. So this loss which been previously generated, it cannot be offset with the next year profit. Moving to next slide. Authorities has defined some rules under which tax losses can be carried forward. So there should be a maintenance of minimum 50% ownership from the tax period of loss to the tax period of offset. For example, a shareholder with 55% shareholding has been replaced by another shareholder in 2025 as compared to the taxable period of 2024. And in 2024, entity has recorded a tax losses, then these losses cannot be offset with the next year. Next condition is that there should not be a drastic change in the business operation. If there is a change in the ownership more than 50%, so authorities would look into it more deeply. If they think that there is a drastic change from the core activities, or they have, or entities has formulated new design services processes, so authority would apply would apply their judgment and they would look into it vigilantly. So all these conditions has to be met in order to claim this tax losses in the subsequent year. However, there is one thing, there is one exception, that if the company has shares listed in the stock market, then above criteria would not be applied, and the previous year tax losses can be carried forward to the subsequent taxable period. Moving to the next slide. As we have discussed that the taxable losses can be offset with the next year taxable profit. Now we would see whether these tax losses of one entity can be offset with another entity. So for that, following criteria has to be met. Both taxable persons should be legal person and should be resident person as well. If one person is in free zone and generating qualifying income, then this and are also creating taxable loss, then this taxable loss would not be adjusted with this taxable profit of other company. Both the entities should have common shareholding of at least 75%, means in both the entities, at least they should have same shareholding of shareholders of 75%. And also, if there should be a same financial year for the both entities to offset the taxable loss of one entity to the taxable income of other company. If there is difference in the financial year, or companies are pursuing different accounting policies, then it cannot be offset. Moving forward, there are some transitional rules being applied from 10th October 2020. As per these rules, opening balances need to be adjusted with all the IFRSs if the closing balance of previous year is not prepared as per IFRSs. Also, opening balances should be prepared by arm's length principle, so that there should not be a drastic change in the comparatives, as well as the current year financial statement of 2024 and 2023 respectively. If company is trying to change a tax period, or they are making a deliberation in the shareholding, then the provision of Article 50 can be applied, which is known as GAR. So I would explain about this GAR in next slide. And next point is, Cabinet can also issue a decision on other transitional measures, which is still not being published yet. Moving to next slide. A transaction or arrangement should not be executed in such a way that it don't have any commercial reasons. Management can apply different transactions in the financial statements, so that they can get an advantage in the corporate tax calculation. These advantages can be like a refund or increased refund of corporate tax, or avoidance or reduction of corporate tax payable, or any deferment of the payment of corporate tax. So management need to be vigilant that the GAR can be applied, and the authorities can allow and disallow any exemptions or deductions or relief in the calculation of taxable income if they think that this is giving an undue advantage to the management, and management is using these things for the reduction of corporate tax. Moving forward, now I would explain some points in the administrative compliance matter. Entity which is going through a taxable activity should need to apply for the corporate tax registration. This corporate tax registration number would be different from the VAT registration number. In contrary to this, a person who is now decided that they would close a business, or they have intention to close a business, then application should be filed to the authority so that they can deregister the company from the corporate tax. Moving forward, a tax return should be filed within the corporate tax should be filed within 9 months from the end of the relevant tax period. So in the tax return, the management or the account side has to mention the tax period, the name, address, or tax registration number of taxable person, accounting policies they have pursued in the preparation of financial statement or taxable income, or any tax loss relief claim or losses transferred. These needs to be highlighted clearly so that authorities can read these things and they would know that the corporate tax which has been calculated is accurate. Financial statement is basically the main baseline over which this taxable income would be calculated. So authorities can ask the management to give this financial statement. So all these financial statements relevant with the corporate tax should be audited so that if there is demand come, then they can provide to the authorities. Moving to next slide, just like VAT law, the corporate tax law has made it compulsory for a taxable person to maintain all the accounting records and documents for 7 years following the end of tax period. The tax period would be the financial period, and in most of the time it would be 12 months. However, if the incorporation happened during the corporate tax period, then this period can reduce. For example, a company which has incorporated in March, so the company would have a financial year of 9 months, and subsequently then the taxable period would also be of 9 months. So I would explain you one example relating to the calculation of corporate tax. We have two companies, company A and B. They have company A has a sale of 1.2 million and B 1 million respectively. By deducting all the direct expenses and indirect expenses, we come to a figure of a net profit 450,000 for company A and 250,000 for company B. So as you know, this threshold limit is for the deduction is 375,000. So by deducting this limit and by adding back the 50% of the director's entertainment expenses, which has been told by Chetan that the authority is only allowing 50% of the director's entertainment expense, we reach to the figure of 90,000 as chargeable taxable income. Over this income, we would apply 9%, and the company A would have a net tax payable of 8,100. Whereas for the entity B, the taxable income is below the threshold limit, so there would be no chargeable taxable income. Now I would transfer the mic to Mr. Rajiv to give away the points related to the corporate tax and do the closing remarks.
Thank you, Mr. Sajjad, for taking us through the almost end of our presentation. Now we all understood that what is the corporate tax, how it is applicable on residents, non-residents, free zone persons, what are the provisions for the losses, how we are required to file the corporate tax return, how many years we need to keep the records, and so on. Now, before we end up our session, our webinar, let's look at the key takeaways that now you have understood what is the applicability of the corporate tax. So now let us understand what at your company level you are required to do or you are supposed to do. First, that you are required to assess the corporate tax applicability on your company, but that assessment has to be on a hold until the cabinet decision or executive regulations are in effect. Because as we all know, we still have some time to check that what loopholes in our company is, or by how we can do the better compliance with the corporate tax. At the same time, we have to keep in mind the red flag of 10th October 2022, that is GAR, that we should not change any kind of a transition or the legal to have a corporate tax advantage. Another thing is that the tax group decision on the prima facie, it looks very good, that lower compliances, no applicability of inter-company arm's lengths, and if one company is in a loss, so on the same year, the overall profits can be minimized and the cash outflow can be minimized for the corporate tax payment purposes. But at the same time, we have to see that by having a tax group, we are going for a single exemption limit. Even if we might have five five companies under one tax, so that kind of monetary loss we have to see, and we have to do the cost benefit analysis. In the last couple of years, 5 years or almost 6 years, we are seeing that the UAE is from non-taxing country coming to the taxing country. Started with the excise, value-added tax, anti-money laundering, ultimate beneficial owner, UBO, ESR, and then now corporate tax. Now we need a qualified professional accountant who can handle all the compliances of companies. Yes, the third-party professionals, third-party service providers, or the professionals like us are there, but management has to realize that the compliances are required to be fulfilled by the company. So yes, this is a need of the hour, that you are required to hire a qualified or professional accountant. Now, before the CT law effects comes into effect for your company, let's say your company is following the 31st December. So for you, the applicability is from 1st January 2024. So before we step into 2024, we should relook in our balance sheet, in our financial statements, in our statement of financial position, that is there any income which is not recognized in the P&L, or are there any expenses which are still standing as the liabilities? Is there any ungenuine assets or liabilities which can be written off, should be written off? Because when the corporate tax comes into play, comes into effect for your company, the old losses or old expenses will not be allowed. Let's take for an example that in your financial position, there is a accounts receivable of, let's say, 100,000 is sitting since 2 years. But after of all your efforts, you are not able to collect that money back. So in the, if you think that you will write off this accounts receivable in the, let's say, 2024, so that your corporate tax liability can also be come down, but that will not be the case, because ultimately the corporate tax will be applicable for your income and expenses of 2024 only, for that year only. It will not be, it will not allow you to claim the expenses or the claim the income of the previous years on which there is no corporate tax. So this kind of small things can affect our corporate tax liability, corporate tax computation. So for which the transitional rules will come through the executive regulations. And last but not least, the businesses must create the capital. By creating the capital, in the sense that the businesses must maintain the books of accounts. We have seen that in the business practices, the maintenance of books of accounts has greatly came with the effect of a value-added tax. But still, at presently, we also see that there are still many companies who are not even maintaining the accounts books, which is required by law. who are registered under VAT or excise, it is required under law that the maintenance of books of accounts is compulsory. The tax procedures law is already in effect since 2017. Even the corporate companies law or the free zone laws are also saying that books of accounts are required to be maintained compulsorily. But when the corporate tax is there, so it might be possible that federal tax authority might knock on your door to first start with your assessment, and to start the assessment for the corporate tax, they will first ask for your books of accounts. So, and if you prepare a books of accounts, you can create your capital. Like let's say that a shareholder is purchasing a 10 million villa down the line, let's say after 5 years. So it may be possible that the federal tax authority will ask them that how you created, from where you got this investments, how you created this capital. When you have created your books of accounts, when you have created your capital, so from that you can say that I'm running this business, from that I got this much profits, and from that profit I'm buying this villa. So this is just a small example for creating a capital. With this, I thank all the attendees for attending our session on the effective of corporate tax on your company, the effectiveness of the corporate tax in the UAE. And I also thank my colleagues for their presentation. And with this, I open the house for the question and answer. Our first question. Our first question is from Lena, that are we supposed to follow a specific COA for our reference? No, there are no specific COA which needs to be followed for the corporate tax purpose. Yes, the corporate tax return format will be given by the Federal Tax Authority, which we are supposed to file. I hope I answer your question. We have another question from Mr. Irwin. Is the corporate tax applicable to both mainland and free zone companies? I request Mr. Chetan to answer.
Yes, Mr. Arvind. Corporate tax will be applicable to mainland and free zone both the companies. But as I explained earlier, that if the free zone companies are fulfilling certain conditions and they are considered as a qualifying free zone, then and they are having the qualifying income, then they will have a 0% tax benefit. But still, they need to register for the corporate tax and they need to fulfill all the conditions. I hope it answered your question.
Thank you, Mr. Chetan. The next question is from Lena. Can you please elaborate the FZD city, like corporate tax applicability on the free zone? Mr. Chetan, please.
Hi, Mr. Lina. Yes, free zone persons are also covered under the corporate tax, and they will have to register for the corporate tax also, as I mentioned to Mr. Arvind also, that free zone companies, if they are fulfilling all the conditions and they are having the qualifying income, then they will be they will have the 0% tax benefit, but still the corporate tax is applicable to them.
Thank you, Mr. Chetan. We have our next question from Ms. Lena again. If the corporate tax period is February 1st, what is the first filing deadline? So at here, your first corporate tax year will be from 1st February 2024 till 31st January 2025. And you are required to file the corporate tax return with the payment on or before 31st October 2025. I hope I answered your question. Next is from Mr. Irwin. Please define what is meant by qualifying free zone person. Mr. Chetan, again to you.
Hi, Mr. Arvind. Yes, qualifying free zone person means the free zone person who are fulfilling all the conditions which is mentioned in the law, that they are having they are maintaining adequate sustenance, they are deriving the qualifying income, they have not opted for the 9% corporate tax and any other conditions which may be prescribed by the cabinet. If they are fulfilling all the conditions, then the free zone person will be considered as a qualifying free zone person. I hope it answered your question.
And to add at here, Mr. Arvind, at presently the meaning of adequate substance we are taking from the economic substance regulations law. But if the executive regulations of the corporate tax define something different, then yes, the answer may differ in the future. Thank you. Our next question is just from Mr. Jitendra. Just want to confirm we are under export of service and it is zero rated tax rate sell as per VAT. Do we need included commission income also under total sale? Which while checking threshold limit as per corporate tax. Mr. Jitendra, please note that the corporate tax is not applicable based on based on based on the sales or the revenue of the company. It is based on the net income, net taxable income of the company. So unlike like VAT was applicable based on the sales value or the services rendered value. Yes, so corporate tax is not applicable on your sales value. You have to check that whether your net profit is above the limit of 375,000. But nonetheless, the registration for the corporate tax is not dependent on any value. Is just dependent that if you are doing a taxable activity, you are required to register and you are supposed to file the corporate tax return. The value, the threshold of 375,000 comes into play only when to calculate your corporate tax liability. Other than that, the limit does not have any other um, any other the limit will not be considered for any other criteria for the registration purpose or for the corporate tax return purpose. I hope I answered your question, Mr. Jitendra. Mr. Riji, I have already read your question, are which will answer separately by our client relationship manager. Thank you. We have another question for Mr. Biju. In the UAE, there are many companies that are not audited annually or maintain their books of accounts apart from VAT. How will this company choose their fiscal year? Does the company choose its financial year now? Mr. Biju, in the corporate tax, they have mentioned it clearly that if you're following financial year, yes, you can follow it. If you are not following, then you are required to follow the Gregorian calendar year, that is Jan to December. So yes, for the corporate tax purpose, you can follow Jan to December corporate year. I hope I answered your question. We have again question from Mr. Irwin. Please advise if entertainment expenses include travel expenses. I request Mr. Chetan to answer.
Hi, Mr. Arvind. Yes, entertainment expenses. If we check the definition, they have included that transportation expenses or any other entertainment expenditure incurred for any stakeholders will be included as will be a 50% disallowed as an entertainment expense. But even if cabinet decision will prescribe more provision on this one, so yes.
Mr. Arvind, at here, let's say, take an example. Let's say that you have given a travel ticket to your customer from UAE to, let's say, Switzerland. So yes, that will be considered as an entertainment expense, and you'll be only able to claim 50% of that. But let's say that you are the owner of the company and you are going for the business travel, let's say from UAE to UK. That kind of travels are not an entertainment travels. Then those travels are for the business purposes. So those kind of expenses will be allowed at 100%. Our next question is from Mr. Biju. Does the loss carry forward only able to be adjusted in one tax period circle, means next year only? I request Mr. Sajjad to answer this. I think there is some technical glitch in Mr. Sajjad. So, Mr. Biju, the carry forward of losses can be for the indefinite period. Yes, it is defined in the corporate tax law that that the losses can be carried forward for the indefinite period. Let's say that you have a loss in the 2024, which you cannot fully set off in the 2025. You can carry forward to 2026, 2027, or till the year you get the full set off. I hope I answer your question. We have a next question from Mr. Fusion, I'll say. What will be the treatment of goodwill and tax aspect on transfer of going concern? At presently, unlike VAT, the corporate has also given us the options of a transfer of going concern. That yes, if there are mergers and acquisitions, those kind of transactions will be taken at a tax neutral basis. There is no corporate tax on the either of the parties, the seller or buyer parties. So the 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 there will not be any treatment of the goodwill. But yes, when the buying company creates a goodwill in their books of accounts after the purchase agreement, so we have to wait for the executive regulations that on those kind of goodwills, what could be the impact, like how many years we can amortize those kind of goodwills. So yes, we have to wait for the executive regulations. But as far as the transfer going concern is concerned, for that particular transaction, there is no corporate tax. I hope I answered your question. We have a next question from Mr. Iyer. Is taxes applicable to offshore companies too? I request Mr. Chetan to answer.
Hello, Mr. Iyer. Yes, corporate tax is applicable to all the companies which is incorporated in UAE, and offshore companies will also be covered. But what income will be taxable and what income will be under the 0%? We will have more clarification once the executive regulations comes.
So, Mr. Ayala, like same like the qualifying free zone person for the offshore companies, also we are expecting to have proper regulations in the executive regulations, proper provisions on the executive regulations, and yes, we need to wait for that. We have a next question from Mr. Ansar. Can you please advise whether corporate tax effective for free zone companies which are doing cross-border transactions? I request Mr. Chetan to answer.
Yes, Mr. Ansar, corporate tax is applicable to all the free zone companies, irrespective of their transactions, but they will have 0% tax benefit on their qualifying income. So that is not yet clear. So we will wait for the executive regulations for the transaction which are covered under the 0% tax rate. But yes, it will be applicable to all the free zone companies.
And moreover, Mr. Ansar, if you remember under the public consultation document, they have specifically said that if a free zone person is transacting with the outside UAE, so those will be considered under 0%. So similar kind of provisions we are expecting under the executive regulations. But yes, we should be waiting for that. Thank you. Next question from Mr. Manohar. We prepare consolidated affairs including entities in UAE, Qatar, Bahrain, Oman. Will CT applicable on consolidated income? At presently, based on your question, I can say no. The corporate tax will be applicable on the UAE taxes only, but it also depends based on the shareholding which you are having at the Qatar, Bahrain, and Oman. If they are like 100% subsidiary, or let's say they are like branches of your UAE company, then yes, the corporate tax will be applicable on the consolidated income. But if you are having the single, separate entities bearing them that there are the same shareholders in all the companies of over all the jurisdictions, then only on the UAE income, the corporate tax will be applicable. We have a next question from Mr. Nikhil. Is payment to third party on behalf of shareholders as a dividend allowed under CT? No. The payment of dividend to the shareholder itself is not an allowable expense because the dividend is an appropriation of income. So it will be not allowed as an expense, whether paid to shareholder or to third party. And moreover, the dividend is normally paid to the shareholder, not to third party. Maybe, maybe on the instruction of the shareholder, you might be transferring the dividend amount, the amount of the dividend to the third party based on the shareholders instruction. But nonetheless, the dividend are not allowed as an deductible expenditure for the calculation of taxable income. We have a next question from Mr. Said. Could you specify, please, for e-commerce business having head office in Turkey and importing their products here in UAE through appointing a delivery channel as a consignee with no office presence, will they be eligible for CT? Yes, they are covered under the corporate tax because they are covered under a non-resident and they are earning state sourced income. If I go back to my slide where there are conditions that if you are earning a state source income, then yes, you are covered under the corporate tax. So for the e-commerce business who are selling goods in UAE to the resident persons here in UAE, so you are earning a state source income and you are covered under the corporate tax. Next, we have again question from Mr. Biju. When do we need to register if the financial year is from Jan to December? Is there a deadline? I request Mr. Chetan to answer.
Hello, Mr. Viju. As of now, there is no deadline to register for the corporate tax, but yes, we need to register for the corporate tax before it becomes applicable. So it is advisable to register before the corporate tax becomes effective. I hope it answered your question. And Mr. Mohammed, the same question, hopefully I have answered your question.
So thank you, Mr. Chetan. And the next question was from Mr. Mohammed. What is the CT registration date? As Mr. Chetan has already answered, there is no deadline for the registration. But yes, FTA, Federal Tax Authority, expects you to register for the corporate tax before it applies on your company or on your organization. We have a next question from Mr. Abhilash. Do we need to keep the same VAT group company in corporate tax also? Mr. Abhilash, it depends if you are attaining the conditions which the corporate tax has given, because the grouping conditions under the VAT are very simple. That if you are having a one common ownership, you can make a VAT group. But in the corporate tax, the first condition itself is that 95% shareholding has to be there. So first we need to look into that if you are attaining that condition, based on that only you can create the corporate tax. It is not compulsory, or it is not compulsory that if you are under a VAT, if you are under the grouping under VAT, so in corporate tax also you should be under grouping. No, there is no such condition. So first you need to see that whether you're meeting the grouping conditions under the corporate tax. I hope I answered your question. We have a next question from Mr. Saurav. If a company have branches and one branch is in free zone and other in the normal zone, and books are prepared for whole company only and not for branches, then how will decide taxation of corporate tax if one branch is qualifying free zone branch? So, Mr. Saurav, your question was well answered in the public consultation document, but in the final decree law, this is still not answered, we have to wait for the executive regulations. But yes, I can say that at presently I can suggest you one thing only, that start preparing branch-wise books of accounts, because tomorrow it might be possible that your branch, which is in the free zone, may qualify for a 0%. So the authority, the Federal Tax Authority, will ask you to prepare separate books of accounts. So at presently, I suggest you to start preparing the separate books of accounts. I hope I answered your question. We'll take this last question due to the limitation of time from Ms. Bhageshri. Our inventory residential apartments are booked at cost price. If we change the method from itself and start booking at market value and simultaneously start charging depreciation on it, so the next year the opening balance will be at higher value, which ultimately lead to lower GP. Can we adopt this practice? Ms. Bhageshri, this kind of practices after we know that the general anti-abusing rules GAR is already in effect from 10th October 2022 is not at all suggested. But under the IFRS, it is given that once you have chosen any method, that method should be consistently followed under the accounting policies. At here, I request Mr. Sajjad to give some light that under the IFRS, this method can be changed or not. Mr.
This method can be changed, but the problem is that if you are changing this method, then as per the policies, you have to apply retrospective effect as well. So your opening balances would also be changed. So you need to be mindful of the fact that your opening balances would change by these policies, as suggested by Mr. Rajiv, that as now GAR has been applied, so you should be reluctant to follow the policies which authorities can question you.
So I think Ms. Babageshri, you have understood that by applying this new policy for changing the costing of your residential apartment from the cost price to the market value will lower down your gross profits and ultimately will lower down your corporate tax liability, which is ultimately a corporate tax advantage, which is very well covered under the general anti-abuse rules GAR. So we will not suggest this. Thank you. The rest of the questions we will answer individually to all the persons, to all the attendees. And we thank you everyone for attending our session. Thank you so much. Have a great day ahead.